Facility in Oshawa, Ontario, is the latest Canadian auto plant to feel the effect of U.S. tariffs. The plant will be cutting back operations, moving from 3 shifts to just 2 starting this.
Welcome back. General Motors this morning cutting its outlook for 2025 because of a $4 to $5 billion dent in profits over.
As of late May 2025, General Motors is under mounting financial pressure due to the latest round of U.S. import tariffs on vehicles and auto parts.
A $4 to $5 billion impact from tariffs that we shared.
According to statements made by CEO Mary Barra, the tariffs could cost the company up to $5 billion this year, prompting GM to revise its 2025 profit forecast downward. Although the automaker has not suspended production, the financial impact has already begun to ripple through investor confidence. GM's earnings update on May 1st triggered a wave of volatility in its stock, reflecting growing market anxiety about the broader effects of trade policy on American manufacturing. There were no strikes, no supply chain breakdowns, just a warning loud and clear that policy decisions made in Washington can send shockwaves across entire industries. The situation at General Motors is no isolated event. It's part of a growing trend that's rippling through U.S. manufacturing. In 2025, a new wave of import tariffs ranging from 25% on steel and aluminum to elevated duties on semiconductors and critical auto components has sharply increased the cost of doing business. Automakers heavily reliant on global supply chains are now under immense pressure to absorb or offset these added expenses. GM has tried to adapt. The company has slashed marketing budgets, shifted to alternate suppliers, and ramped up domestic sourcing in an effort to cushion the blow. But by May, CEO Mary Barra publicly acknowledged that tariffs were expected to cost the company between $4 and $5 billion this year, alone an unsustainable burden in a highly competitive market. While GM has not formally halted production, the mounting costs have forced the company to reassess every line of spending. For an industry already facing shifts in global demand, EV competition, and labor costs, the new tariffs are pushing operations closer to the edge. And GM isn't alone across the sector. Manufacturers are beginning to retreat, rethink, and in some cases scale back output to stay afloat. At the core of GM's current challenges lies a deep policy shift embedded in the renewed America First economic strategy. In early 2025, the U.S. government reintroduced broad-based tariffs on imported vehicles, auto parts, and critical manufacturing components, with rates reaching 25% on items like semiconductors, steel, aluminum, and EV battery materials, many of which are sourced from Asia, particularly China. This policy, aimed at reshoring supply chains and protecting domestic manufacturing, has dramatically increased input costs for automakers who still rely on global suppliers for efficiency and scale. GM, along with other major manufacturers, now faces a double bind: rising production costs that can't be easily passed on to price-sensitive consumers. Compounding the pressure is a proposed tax overhaul currently advancing in Congress. Backed by Republican lawmakers, the legislation targets the rollback of clean energy incentives, including the $7,500 federal tax credit for new electric vehicles and the $4,000 credit for used EVs. As reported by the New York Times on May 14, 2025, the bill would begin phasing out these benefits within the year and eliminate them entirely by 2026. For GM, which has invested heavily in its electric truck and SUV lineup, with several models priced around $60,000 to $70,000. The policy shift comes at a critical moment. These vehicles were designed with federal subsidies baked into their market assumptions. Without them, the financial burden shifts directly to consumers, many of whom are already grappling with elevated interest rates, inflationary pressures, and stagnant wage growth. Dealers in several markets have begun reporting a drop-off in EV inquiries as buyers recalculate affordability. GM8 itself has not yet adjusted pricing, but analysts suggest that sales forecasts for high-end EVs may need to be revised downward if the credit rollback proceeds as planned. What was once promoted as a policy to strengthen American industry now risks pushing companies like GM into a corner caught between policy-driven cost inflation and demand-side cooling. In effect, the federal government is sending 2 conflicting signals, one that urges domestic production and another that reduces consumer incentives to buy the very products being promoted. The result is not just a test of GM's resilience, it's a stress test for the entire vision of American industrial revival. Without a more coherent policy framework, the strategy risks becoming a squeeze on both ends, higher costs for producers and fewer tools for buyers. When a major automaker like GM slows down even without a full shutdown, the ripple effect is swift and deeply personal for communities built around industrial supply chains. In Texas, a regional freight operator has reportedly paused new driver hires, citing uncertainty in auto-related volume after a major client in the Midwest began reducing its shipping needs. Similar cases have been noted in logistics hubs tied to automotive production. In Ohio, a precision parts supplier was said to have received same-day order cancellations from a large customer, leaving materials staged and workers standing by without clear next steps. While specific names haven't been disclosed, this kind of last-minute disruption is increasingly common according to manufacturing associations. In Michigan, a diner located near a GM plant reportedly saw a sharp drop in morning foot traffic, with one local source estimating a 40% loss in regular breakfast customers, many of whom were shift workers. "It's noticeably quieter before 8 a.m., one manager told regional media. "That used to be our busiest window." Meanwhile, in Indiana, an independent tool and die shop that supplies EV molds is said to be considering workforce cuts of up to 50% if production orders don't stabilize soon. "We're not panicking yet," said a shop representative, "but we're preparing for the possibility." These aren't just isolated anecdotes. They're snapshots of a larger pattern. When the assembly line slows, it's not just machines that go idle. It's paychecks, delayed, local businesses, strained school budgets tightened, and municipal tax bases weakened. For towns built around industry, the pause of a single factory can feel like the loss of a heartbeat. As the economic pressure mounted on General Motors, many expected the federal government to offer relief, or at least reassurance. But none came. Despite GM's public disclosure in May that tariffs could cost the company up to $5 billion in 2025, the White House offered no targeted response. Instead, President Trump, speaking at a rally in Pennsylvania, briefly acknowledged the mounting tension. "We've supported American companies every way we can. They've made their decisions. We've made ours." There was no anger, no policy reversal, just a political shrug. Privately, GM had hoped for tariff exemptions or a fast-track appeal process. What it received was silence. In a year already shaped by inflation and flagging consumer demand, the message was clear. This administration isn't budging. For companies caught in the middle, it's not just a policy dilemma, it's a political reality. What's happening to GM is no longer just about one company's struggles, it's becoming a broader warning sign for American industry as a whole. In the first half of 2025, U.S. industrial production has declined for 3 consecutive months, according to data from the Institute for Supply Management (ISM). Factory output remains subdued, and new manufacturing orders are stagnating. The most recent ISM report notes that delivery times are lengthening, and companies are increasingly cautious about restocking inventories, classic signals of a sector under pressure. At the same time, the U.S. GDP shrank by 0.3% in the first quarter, a steeper decline than analysts anticipated, prompting several major banks to revise their full-year forecasts downward. With trade tensions still escalating, few expect a meaningful rebound in manufacturing before the end of the year. Behind closed doors, other automakers aren't staying quiet. Sources close to the industry told Reuters that executives at Ford and Toyota have held emergency meetings in recent weeks to evaluate contingency plans, including the possibility of temporary production pauses if tariffs on components from Asia continue to expand. This isn't just an isolated business disruption. It's the slow tightening of an entire ecosystem: logistics, assembly supply chains, employment, and consumer confidence. What began as a policy experiment is now showing signs of becoming a structural slowdown, one where uncertainty, not just cost, is the main threat. If even General Motors, the industrial giant once rescued by the U.S. government, can't stay afloat under today's economic policies, who will? That's not just a question for investors or executives. It's a question for everyone who depends on stable jobs, affordable goods, and a thriving economy built on more than just slogans. Share this video if you believe that American manufacturing needs more than tough talk. It needs smart policy. What do you think about the future of U.S. industry under current tariff policies? Drop a comment below. The silence on the assembly line today might be the warning bell we all need to hear.